Guys, the S&P 500 down to just 3% in the next decade. This is what's being predicted by folks over at Goldman Sachs. And on this video, I want to talk to you about what it is, why it is, and what you can be doing to prepare. Listen, investors need to take note. And if you're watching this video, I'm assuming you're an investor, so you have to be able to adjust. Now, over the past decade or so, the S&P 500 index has experienced, guys, some ridiculous growth, right? Crazy growth, almost by 198.5% over the last 10 years. Now, this translates into an impressive 13% total average annualized rate of return over the last 10 years. Strong performance in the U.S. stock market over the last 10 years. Now, I want to talk about why, and then I want to look at a specific article, and then I want to talk to you about how you can be preparing and what you should be considering coming up. Now, as you see on my screen, guys, we've got the St. Louis Fed's chart of the S&P 500 over the last 10 years. But we're going back here from 2014 up until today. Now, by the way, this big dip right here where it went down, that was when the pandemic started, right? Right around March or so of 2020 when it hit its low right there. But you can see a rising of the S&P 500 over the last 10 years as reflected on this chart. Right? And why is that? Well, you've got the tech sector dominance over the last 10 years or so, right? The tech sector dominance has been one of the most, probably the biggest contributor to this incredible rise in the S&P 500 over the last 10 years. You got your Max 7, your Facebook, your Apple, your Meta, your Apple, your Amazon, your Google. Now in the last few years, you've got your Nvidia, you had your Tesla. Those companies contributed hugely to this gain in the S&P 500, not to mention monetary policy, right? The Fed, we carried some low interest over the last 10 to 12 years or more after the 2008, 2009, 2010 debacle, that financial crisis has happened, right? Up until obviously the pandemic that occurred in 2020, 2021. But for the most part, the Fed's low interest has really supported this huge increase in the S&P 500 over the last 10 years. We had low interest rates for quite a while. Now, those low interest rates that we had all through the teens from 2011 up until 2021 or so, those low interest rates made borrowing cheaper, which encouraged corporate investment and corporate growth and consumer spending. And that benefited companies, right? Low rates made stocks more attractive than things like bonds, right? Not to mention you had this large amount of earnings growth. Many companies within the S&P 500 had substantial earnings growth over the last 10 years or so. Cost efficiency, innovation, obviously global expansion has been a big key to all that as well. But these strong corporate earnings have again also provided support for higher stock prices. Also, we can expand on the global economic expansion that we saw, right? The U.S. economy had periods of slow growth. It's generally expanded over the last 10 years, as you can see on this chart in terms of stocks and stock prices, right? But the global economy has expanded even more and more. And obviously, that's going to benefit those big companies that have significant international exposure, like technology and the Max 7, which is really leading this whole charge in the S&P 500. And then as we bounce back from the pandemic, that was a big boost and boom as well, with all the PPP loans and stimulus payments and all of the liquidity that was pumped into the market by the Fed when they decided to go ahead and provide everybody with stimulus checks and really enact their quantitative easing. So you saw the S&P get these significant gains at the very beginning of the pandemic in 2020 and 2021, which contributed to the strong 10-year run. Now, we know also that in 2022, we had sort of a down year in the S&P 500, one of the only down years in this sort of 10-year bull run. But investor confidence, consumer confidence has been really high for quite a while. So when you look at the PE ratio of stocks, or if you look at the PE ratio of the overall S&P 500 as an entire index, you see higher than normal PE ratios, higher than the traditional PE ratios. Now, sometimes, guys, that can indicate a bubble. And I think that's part of what Goldman Sachs and some of these other folks are saying right now, and that many of these stocks in the market are really overpriced. But basically, it means that Investors have been willing to pay more for a dollar of earnings, which reflects optimism about future growth, about low interest rates, and about where the economy is going. Everybody's feeling good. But all these factors combined is what's led to this above average return for the S&P 500 at 13% over the last 10 years, which brings me to the whole point of the video. What's going to happen in the next 10 years? Now, there was an article that came out just yesterday, and I want to share it with you. Goldman forecasts just a 3% S&P 500 annual return in the next 10 years, down 13% from the last decade. Now, in this article, and I'll just kind of read a little bit of it, the S&P 500 will serve up a minuscule return over the next decade that falls far short of the booming gains from the last decade, forecast Goldman Sachs equity strategy team, citing today's high concentration in just a few stocks and a lofty starting valuation. The broad market index will produce an annualized nominal total return of just 3% in the next 10 years, according to the team led by David Costin, which would rank it in just the 7th percentile of 10-year returns since 1930. Now, the S&P 500 returned 13% annually, as I mentioned, above the long-term average of 11%. Goldman's bearish long-term forecast of just 3% comes just as the S&P 500 has entered into the third of a bull market, garnering a 27% annual total return the last 2 years. Guys, that is huge, and it's really unheard of. But you're talking from right now, 27% annual total return over the last 2 years. What does that tell you as an investor? It tells you there's probably a bear market right around the corner. You can be as bullish as you want, and you can be as hyped up as you want, but it means, according to the historical data, right around the corner, there's some issues coming. And it goes on to say, investors are extremely bullish on the notion the economy weathered an inflation surge, which it did, and will now have several Fed Reserve rate cuts at its back. Now, when the Fed cuts rates, that always incentivizes spending. It incentivizes growth. It incentivizes businesses to go out and buy that new equipment, or go out and get another loan to go purchase something to grow the business. It usually incentivizes a bullish type of feel for the market when the Fed starts cutting the rates and making it cheaper to borrow money, right? So just keep that in mind. Now, look at the rest of the article. But Goldman's team is worried that these returns have been driven by just a few stocks. That's the kicker right there. That's a big one right there, namely the Mag 7, led by NVIDIA and Alphabet, and there's others, right? And that a few stocks can only keep up their dominance for so long. In other words, technology, the Mag 7, is going up and up and up. And according to history, it can only go up for so long. Now, it says the intuition for why concentration matters for long-term returns relates to growth in addition to valuation. Our historical analysis shows that it's extremely difficult for any firm, any company, to maintain high levels of sales growth and profit margins over a sustained periods of time. But it says the current high level of equity valuations is a key reason our 10-year forward return forecast sits at the lower end of the historical distribution. Along with the baseline forecast, Goldman's model gives a range of annual return possibilities from plus 7% annually to a negative 1% annually. Now, the firm said the forecast suggests a 72, this is key right here, guys. The firm said the forecast suggests a 72% probability that stocks trail bonds in the next decade. Goldman said the equal weight S&P 500 would produce higher returns than the regular benchmark because of the concentration of risk, right? When you have the regular S&P 500 is weighted by cap. The equal weight S&P 500 is not weighted by cap, and therefore it could enjoy some higher returns than the regular S&P 500, right? Now, listen, here's another kicker. Goldman is not alone. JP Morgan is similarly pessimistic over the long term, though not so much as Goldman. JP Morgan forecast last month the S&P 500 annual return for the next decade would be about 6%. right? Conservative, but still more than what Goldman is. JP Morgan cited high valuation, just like Goldman, along with the higher than average inflation tied to large fiscal spending. Persistent inflation could weigh on market multiples, is what JP Morgan was saying. But Goldman researched the 10-year equity return assumptions of 21 asset managers and computed that they are predicting, on average, U.S. equity returns of 6% over the next 10 years. So very, very important, guys. Very interesting information for you to know. And as an investor, our job, or my job, I feel like, is to let you guys be aware. Now, this little article was sitting somewhere. It wasn't mainstream, all out on the front page of anything. But it's important that it be brought to your attention if you are a investor. You need to know what they're saying about the forecast. It's not, nobody knows for sure, right? Exactly what's going to happen over the next decade. But here you have people that are studying the thing, looking at the thing. Their full-time job for 50, 60 hours a week is to look at this and forecast. And they're telling you that this market that we're in can't last, won't last. In the next 10 years, things are going to change. So that bears the question of, what should you do? Let me give you some alternatives to the S&P 500, because the S&P 500 is very tech heavy. And if you see a volatile sector that's cyclical, like technology, leading and carrying the weight, then you got to be thinking about, okay, what are some possible alternatives as opposed to having all my money or most of my money in the S&P 500? Now, this is important for me because I, like a lot of you out there, are in that age range of 40 to 55 or 60 years old, where you're going to be wanting to retire, and you want to know what's happening with your money as you enter into that retirement age in the next 10 years. One thing you can think about, like was mentioned in the article, go with an equal weight ETF or fund, right? Or you could go with a global fund, or you can go for more value. See, the S&P 500 is considered a growth ETF, right? Because it's the top biggest, largest, large cap companies in America, 500 plus of them, right? So you could go for more of a value type stocks or value type ETF that is going to be focused on more so long-term companies and companies that are not so much looking to have that growth, but they're looking to stay steady and steadily grow. Right. And typically these value companies or value ETFs are trading below their intrinsic value compared to their peers or their other companies that are like them, or as compared to the broader market. And they also, these value companies or value ETFs tend to come with higher yields in terms of dividends, but they come with lower expected earnings growth. So they don't have the potential to outdo the market, but they have the potential to still grow, but at a much more steady pace. Your AT&Ts, your Home Depots, your Procter and Gamble's, these really solid companies fall into that value investing strategy, right? So maybe you could do that as opposed to having so much money in the S&P 500. Maybe you can go with small caps or small cap ETFs, right? Where you can hedge against some of the volatility of the larger companies, or hedge against some of the volatility of the tech heavy sectors or technology itself, right? So you've got some alternatives that you could do, or you could actually dig into from a standpoint of actually investing, but maybe not so heavily in the S&P. I'm just giving you a heads up, not telling you what to do. This is not financial advice. It's just my opinion on something that you need to be aware of as an investor. Bottom line is this, guys. You've got to be doing typically what I like to consider about 7 rules. One is creating an investment plan and sticking to it. The second thing is committing to consistency over a stretch of time, not being the person that jumps in and jumps out. The third thing is only investing in what you know. And then, of course, risk what you can afford to lose always. And then always diversify. Don't have all your money wrapped up into one thing, even if that one thing may just be the stock market S&P 500. Think about that, right? I know right now we don't think there's any risk to the S&P 500, but there is some risk, right? And then I always like to reinvest dividends. And then finally, don't panic, right? Don't be the person that is investing off of emotion. So I just wanted to bring this to you guys' attention that the S&P 500 could be down to a 3% rate of return over the next 10 years, as opposed to this 13% that we've seen and have grown sort of accustomed to and gotten really, really comfortable with. It may not look like that in the next 10 years, and you got to know that as an investor. So listen, guys, I hope I was able to help you with something on this quick video. Do me a favor, smash the like button, share the video with a new investor or someone who you think could use this information. Hey, the best person who's going to take care of the old you is the young you. Take good care of yourself and take care of other people. Until the next video, peace.